Guys, thanks for joining. I'm Danny, if we haven't met, and the rest of my real estate crew is here. So thanks for joining us. We're here today to talk about assumable loans. And the reason we're going to talk about that is we think it's one of the best opportunities in the market that very few people are taking advantage of right now. And most people don't even know exists. If you're a seller, assumable, and you have a loan that's assumable, your property immediately becomes way more attractive to the average buyer. If you're a buyer, it's obviously more attractive to you because you're gonna assume a lower interest rate than what's available today in most cases. So, but before we jump into the details around assumable loans, we kind of have to run through a brief history of how we got to where we are today and why assumable loans are so valuable today. So if we jump back to 2020, we're all aware that the coronavirus hit and the world got really weird for a number of years. And part of that was things shutting down, things going remote. There was political unrest, there was social unrest. And when coronavirus hit, we immediately jumped in unemployment from like 3.5% all the way up to almost 15%, almost overnight. And when that happened, the government had a choice, and that choice was, do we either let the economy collapse, or do we come in and try to stimulate the economy? And the government decides, hey, we're going to stimulate the economy. We're gonna start pumping some stimulus, some money into the economy. That came through like PPE loans that then didn't have to be paid back by business owners. That came in the form of there was like a child tax credit. I don't remember if that's the exact right term, but anybody with kids got a stimulus check every month. And that all mattered. The second thing that happened is the Fed came in, who basically determines our monetary policy, and they dropped interest rates. And if you look at this chart, this is basically a chart. This isn't a chart of the Fed interest rate, but this is a chart of mortgage interest rates. They tend to be correlated. And you can see interest rates started dropping all the way back in 2009, right when the Great Recession started. And they dropped pretty consistently all the way until 2020. And then COVID hits, which is this gray line here, and then they dropped to historic lows. So historically low that like we've got a buddy who got a 1.98% interest rate on a 30-year mortgage. That is basically free money. And so when that happened, that created this influx of interest in all things spending, okay? But coupled with that is like within less than a year, our unemployment rate dropped from almost 15% down to 6%. So from an employment standpoint, we recovered really quickly. Part of that's because we were allowed to work remotely, and that offered flexibility, but that also created this like perfect storm for the real estate market specifically. You've got remote work plus shifting housing preferences. All these people that are working remote all of a sudden have different needs, right? You might need like a home office, or with kids doing school from home, you might actually, like we had folks that needed like a finished basement so their kids could do school from home. So you've got those shifting housing preferences coupled with historically low interest rates, which make housing more affordable, creates increased demand. That coupled with supply chain disruption. Do you guys remember this? Lumber prices like 3x'd basically overnight.
Yeah, paint, remember that?
Oh, there was a paint shortage. That's right. Sherwin-Williams lost their entire paint supply basically.
Yeah, the company, the plant in froze.
The plant in
Yeah,
Dallas
that's
froze.
It was the
COVID,
freeze.
that
It
was
was
the freeze in Texas.
Yeah.
The freeze in Texas.
Yep. Shipping containers stopped shipping from overseas for a period of time. And we saw lending slow down for new construction. We had a buddy who's a builder in Denver who just lost his line of credit. The lender just said, hey, we're not going to lend anymore until we see how things are going to settle out. So that plus this influx of investors, right? COVID hits, there's instability in the market, there's a little bit of hesitation to invest in equities. What happens? Investors put their money into hard assets, i.e. real estate, at these historically low interest rates. And that all couples up to a decreased housing supply. And when you have increased demand plus decreased supply, that means the price goes up. And that happened in real estate, specifically in Fort Collins, where we saw in 1 year, we saw appreciation go up 18%. As a country as a whole, we saw inflation kind of get out of control, right? And when inflation gets out of control, when we see housing prices jump like we do, the Fed's response was, oh no. We swung the pendulum really far in one direction and dropped interest rates to historic lows. And now we're seeing the market respond too aggressively. There's too much money in the market. People are spending too fast and too much. And so the pendulum swings really far in the other direction. So we come back to this mortgage rate chart, and we've seen basically for, 12, 13, 14 years, interest rates have basically been dropping. And then in January of 2022, we're sitting at 3% interest rates basically. And by November of 22, we jumped all the way up to 7% interest rates. That's a huge jump, right? We're higher than we were all the way back in 2008, 2009 when the Great Recession happened. So what does that do for us? That just means that it makes housing less affordable, right? Higher interest rates mean your payment's going to be higher. A real life example, this property's on the market right now. This property in 2021 sold for $600,000. The buyer took out a VA loan at 2.8% interest rate, and their payment is $2,100 a month. Well, at the time, the median income in Fort Collins is about 73 grand. That represents, as a percentage of their income, their housing expense is roughly 34% of their income. Fast forward to today, that house is on the market for 650 grand, right? It's appreciated over time. Interest rates are now 7%. That principal and interest payment with 20% down is $3,500 a month. Now we've seen median household income increase to about 80 grand, but the housing cost as a percentage of income is over 50% of the median income. That is a 50% increase in housing costs just in 3 years. That's massive, right? That affects everybody who's in the market right now. So that leads us to talking about assumable mortgages. So what is an assumable mortgage? An assumable mortgage is a government-backed loan, specifically FHA or VA loans. So if you're going to purchase a house, you've got to take out, and you're not paying cash, you're going to take out a loan. You can go get a conventional loan. You can go get many different types of, there are many different types of loan products out there. These two specifically are backed and insured by the federal government. They basically say, hey, lender, if you'll take the risk on this loan, then we'll insure the loan in the event that the borrower defaults on the loan. Assumable mortgages, I'm going to get into some details here in a minute. So how did we come across assumable mortgages? They've been around forever. In fact, the house I grew up in, when my parents bought that house, they assumed the FHA mortgage of the previous owner, of the seller. And that was almost 40 years ago. They've been around. They just haven't been that prevalent over the last 15 years because we've seen interest rates dropping over the last 15 years. So it hasn't made sense to assume a mortgage of somebody from previous years with higher interest rate, right? You just take out a new loan at a new interest rate. However, back in 2022? We had this one listed? Yeah, back in 2022, this was during that year of increasing interest rates, where rates went from 3% to 7%. And our real estate market around here, basically buyers just went, whoa, this is a change we're not used to. And so houses were sitting on the market. This is a listing we had that was sitting on the market. I forget how long it was on the market, but it wasn't selling. We weren't getting much showing activity. And our seller, however, had a VA loan. He had a loan balance of $466 grand. And our managing broker at the time said, hey, you might look into this thing called an assumable loan. So we start digging into it and we find out that, hey, actually, a buyer who's going to occupy this house, even if they're not a veteran, they can still assume this mortgage payment. And that's exactly what happened. We had a buyer come into the picture and they brought the necessary down payment, which we'll get into here in a little bit. And they purchased the house. And instead of purchasing the house with a 7% interest rate that was available at the time, they purchased it with a 3.25% interest rate. That difference in payment was about $1,000 a month. So how did it go? Seller got the price that they wanted. The buyer got a great interest rate and a huge monthly savings, along with, we should have calculated actually what that savings would have been over the life of the loan, but an enormous savings over the life of the loan. But the downside is it took 190 days to close.
And also, something that's cool about assumptions is you're assuming the loan where it's at in its life. So you're not starting over day one on a new 30-year loan. So, if you're several years in, you've already gotten those years knocked off of the loan.
Yeah, and loans are front loaded, right, with interest. You're paying more interest year one than you are year 30. So the further along that loan is in the process, the closer you are to that. What's that called? The inversion of the payment?
So if someone, it could be 12 years into it and you'd have an 18-year mortgage.
Right. There's some details that matter in that, which we'll get into as far as like how to, down payment amount requirements and whatnot. But we'll get into that. So back to 2024, what does that look like today? Well, this is a property that, again, is on the market. We just went through all these numbers. We had a client just put this one under contract. And we like to say we love working with savvy buyers. And our clients they're paying $650,000 for this house. They're paying asking price. They're going to assume this VA loan at 2.875%. Their payment, they're going to assume that existing payment of $2,100 a month. So what does that mean for them? It means they're saving $1,400 a month versus if they went and took out a mortgage on that same house today at 7%. That's 17 grand a year. That's almost 500 grand over the life of the loan.
Did you calculate that on them paying it for 30 years, for example, or did you calculate it on how much was left in the loan?
I calculated that on 27 years left on the loan.
Okay, so they would also technically be saving 3 years in addition to that.
Sorry.
Because they took out 3 years of the loan. So.
Yeah, I think that 500,000 is based on if you're.
I think it was actually
new 30-year mortgage.
No.
It was actually 504,000. So I rounded down a little bit. So there's a few key requirements if you're a buyer and you're wanting to assume a loan. The first is that you have to be able to cover the difference in the purchase price and the existing loan amount. So we're going to use this one as an example. In this example, the existing loan amount was $495 grand. So the buyers have to come up with $155,000 in down payment. That's a hefty down payment for a lot of people, right? However, Dexter's here with Elevations Credit Union. Elevations can do second mortgages on these properties. So if these guys wanted to put 10% down instead of the full 155 grand down, they could do that. And the numbers still work out pretty dang good. So if that was going to be the scenario, they could put 65 grand down and take out a second mortgage with Elevations for 90 grand. And this is roughly what that would look like. Dexter, feel free to jump in at any point. But that second at 90 grand is going to cost about $725 a month. That blended payment of the first and the second is $28.25. Still a savings of $675 a month. I forget our exact interest rate we ran. I think around 10%, maybe 9% on the second. Does that sound right, Dexter?
Your latest number, which was that 8.25, right?
Yeah, 8.25.
8.25 is what we used? Great. So we used an 8.25% interest rate for that second. That blended interest rate is still 3.8%. Basically half of what rates are today. The other key is that you have to be owner occupying the property. You cannot be an investor and assume a loan, an FHA or a VA loan. The other key here is that the buyer is assuming the existing loan, which means you're not buying you're not taking out a loan with a local lender. You're qualifying and taking out the loan with the existing loan servicer on the property. The other thing that's key is patience. So again, our first one that we did took 190 days. We've since done some others that take about 90 days. However, we just paired up with this other company called With Rome. And With Rome offers a service where they guarantee a 45-day closing. There's some cost to that and some details that are going to be worth getting into. For instance, they charge 1% to do that. That can certainly be worth it if you are competing for the property against other buyers, to be able to come in and say, hey, I can get this done in 45 days versus 90 or 190 days. It's going to make your offer way more competitive, but you're going to pay With Rome a 1% fee to do that. We've got 2 going with them right now, and they've been great to work with. All signs are pointing to that being a great partnership.
What's the reason for the longer closing underwriting process?
I think it's a combination of most of the lenders we've chatted with about it literally just don't have the staff to handle it right now. It just hasn't been a thing for 15 years, and so it's new. Like the first one that took 190 days, Lakeview had 1 or 2 people in the assumptions department, and at the time I think they told us they had 300 loans going. I would assume that's changing at this time, but with Rome has their own underwriting process, we'll call it. So they're able to deliver and connect buyers and sellers with the loan servicer, get them everything they need from day one to speed the process up. The other cool thing with their 45-day guarantee, if they can't hit the 45-day, they pay the seller's mortgage payment until the property closes, is my understanding. I'm looking at Steve.
Up to 60 days beyond.
Up to 60 days beyond. Okay, great. The other key with assumable loans is having the long game in mind. I think there's a temptation when you are looking for your first or your second home to find maybe your dream home or something that you can grow into. When we're talking about assumable loans, this is a map of all of the assumable loans currently in the area that are listed. It's a lot less than properties there are actually on the market. So when you're talking about an assumable loan, we would encourage you to, again, have the long game in mind, meaning like, hey, let this be your first purchase. Your commitment with that lender is that you're going to be in that you're going to intend to be in that property for 12 months, for 1 year. If I'm a new buyer and I want to get into real estate investing in some form or fashion, I think this is a great game plan. Because you can come in, you can step into a property at an incredibly low interest rate, commit to being there for 1 year, and then do the process again after that 1 year mark. But there's not a lot to choose from. So you got to be a lot less picky with the properties, and view it from the mindset of, hey, this is going to be a rental one day for me. And if you can do that, you're really going to set yourself up for things to snowball in a positive direction for you. Oops, wrong way. So, next steps, and then we'll jump into like any questions you guys have. But we certainly would encourage you to check out withrome.com. It's ROAM. If you're not signed up for our newsletter, it's really similar to the Assumable newsletter we send out. It's just a way more like aesthetically pleasing website. So if you're on our newsletter, you know we send out this email that says, hey, these are the best assumable loans that are available today, and then we have a spreadsheet. Rome basically takes that spreadsheet, their version of that spreadsheet, and they created a website with it. It's way more user friendly. So we'd encourage you to check that out. Certainly sign up for our newsletter, and we'll get you teed up for what's on the market, and we'll take it a little bit further. We'll run numbers on it, and when we send those out, figuring out how much of a down payment you can pull together, that's going to matter a lot. As you can see, some of those down payment requirements are hefty, but at the interest rates you can assume, it's hard to see a better option right now, in our opinion. And the thing to keep in mind too is that as our time horizon extends, the further we get away from today, likely the higher that down payment requirement is going to be, right? If our market continues to appreciate, then that down payment requirement is only going to increase because that loan balance is going to continue to go down over time. So step after that is getting pre-approved. Obviously, we love Dexter, highly recommend Dexter. And Dexter is going to be teed up and in tune with the Assumable process and putting a second together potentially for you. So even to just start the process of getting qualified, he's going to be a great option for you. And then probably grabbing coffee or a beer with one of us and talking through your specific situation.
Another plug for Elevations for Dexter is that he has the ability to originate loans, 30-year fixed mortgages, as well as that second line of credit or home equity loan. And so he really has all of those different tools at his disposal, and can help guide you on where to tap into that financing.
Yeah.
I would say one other comment, just because I'm like an extreme realist. So for people, just for expectation wise, it's good to know that there's like these assumables listed. That doesn't necessarily mean the seller is either up for it or can, because, for example, with VA loans, that's like a kind of like not a gift, but it's like a honor of, being a veteran, and it's a program that they kind of get allotted amount of points to do this, and they let you assume it, and they can't go and take that somewhere else. So there's been many instances where we've called on one of these, and the seller has said, hey, thank you, but I actually don't want someone to assume my loan because then I can't go and use it somewhere else as a VA. So just something to keep in mind, that this is, the whole thing is a process, and just because the loan can be assumed, that still has to go through the seller as approval from them. So
That's a good point.
just something to keep in mind.
Yeah, that's going to be the primary difference between an FHA loan and a VA loan. Is an FHA loan, there's not going to be any downside to the seller for you assuming the loan, other than probably time frame, right? Because they just take longer to close than a traditional mortgage.
Is FHA the first time home buyer program 3% down typically? Is that
You don't have to be,
usually an FHA loan is?
yeah, you don't have to be a first-time home buyer, but you do have to be an owner-occupant.
Okay.
Yep.
That's 3.5% down.
3.5.
If you want to get real technical.
And is a VA a 0% down?
You can do 0% down.
Up
VA.
if you want.
Right.
And they can only use one at a time, and they have to get out of one before they do another VA.
How does that work, Dexter?
Technically, you could buy another house with an existing VA loan. So if someone kept their first house as a rental, it's about how much benefit they have available remaining. So they have an allotted amount of money that they can use for financing. And let's say they buy the next house and they only have $200,000 left. That's where it could be more difficult for them.
So the allotment is an amount of money that the VA gives them?
Yeah.
Based on rank and years of service?
It's the same across the board. It's conforming loan amounts typically is what they follow.
So if they're moving from here to Des Moines, it's different. If they're moving from here to
From Des Moines to
Boulder.
Well, and that's a great point. Like that example of the house on Crusader that we used, the one that we had listed, and our seller had a VA loan on it. He and his family had moved to Michigan, where their housing expense was going to be way less than it was here. So he wasn't concerned about losing his VA benefit because the down payment amount the proceeds he was going to make off of that sale was going to be plenty for him to put down on the house. It wasn't going to be a benefit to him using the VA loan, or at least not a significant enough of a benefit. But yeah, certainly that is can be the challenge with VA loans. And we had a client recently that made an offer, and the seller had a VA loan, and we didn't end up going under contract, but seller had a VA loan, and he countered us and said, well, I am willing to give up that benefit if you'll pay X number of dollars more for the property than it's listed. So there can be some room for negotiation there as well. And based on that Comet Street example where they're going to save 17 grand a year, would it make sense to pay 10 grand more or 15 grand more for that house to save 17 a year? Maybe, probably. I did just quickly run that savings. If in that example, if these guys buying the house, take that $1,400 a month savings, just put it in the S&P 500 for the next 30 years. That does turn into about $2 million. So you can even get a little bit more crazy with running the numbers on it and go like, oh, well, how can I maximize this return?
Did you run it on Ethereum though?
Yeah, Bitcoin only. What questions do you guys have? Yeah.
The Rome's 1% fee. What is that 1% of? The price or the loan amount?
I think it's actually purchase price. Yeah. Yep.
And that can get divvied up any kind of way. It's going to, as far as who's going to be willing to have their loan assumed and what kind of offer you're able to make, it just depends. Because before we discovered Rome, and actually before Rome, really, I think they only launched in the last few months. But we've been doing our own manual version of this for the last couple of years. But we've found plenty of ones that are on the market, are assumable. They've sat for weeks or months because we're just in a weird market. And so if you are a seller, you've already been on the market for 30 days, and then you get this offer to assume your loan with a 45-day guarantee, there's a lot of properties that are excellent candidates for this. Mm-hmm. And even if, like David was alluding to, even if property just hits the market, if you look at the numbers and you're willing to still compete on price, but to assume that loan, if you're a seller and you have that Rome guarantee where they start paying it after 45 days, that's been the real game changer, is being able to include Rome, explain to agents and to sellers how this works. We have a letter from Rome we submit with the offer. So this has been like an awesome concept for the last couple of years that we've seen kind of work a couple times, and now we can actually put it into practice in a competitive market.
And I think you were going to hit on that 1% fee can get negotiated depending on what that situation is. So if I'm a buyer and I'm offering on a house that's been just sitting on the market for the last 60 days with no other offers, I'm probably writing that offer asking the seller to pay that 1% fee to Rome. And if I'm the seller, I'm probably willing to do that because I would rather sell the house than to not, right? Whereas if you're competing for that property as a buyer against other offers, or it's newly on the market, odds are you're probably paying that 1% fee. Any other questions?
Did you, I think you did, but you mentioned that they have, whoever's assuming the loan has to qualify based on the same, rules. Like in underwriting, you have to qualify for a VA loan, just like how a VA loan is typically qualified.
Yeah, how is a VA loan qualification different than
So VA is going to look at residuals, so they're going to look at square footage and how much it should cost to heat and cool the house. There are other weird factors that get involved. Mm-hmm. In theory, it should be easier to qualify given that the rate's lower, but just kind of be aware. You wouldn't be able to go in and say, I'm ready to assume the loan. You got to be able to qualify for it like a traditional mortgage.
They're thinking they don't want to make anyone house poor and then stretch to stay warm and cool. Is that?
Yes.
Right.
Kind of, okay.
And that goes for the second too.
Yeah.
Yes, you would have to be able to qualify because they'll know you're pulling a second, and so you'll have to show that you can qualify for that full payment. Just so you know.
Yeah, the other unique thing about the assumable loans is there's generally no appraisal unless you're involving a second. I would assume at that point you guys are probably
It depends.
appraising. Okay, it depends.
It's second mortgages are a little more like the Wild West, which is good in some ways, but also can be frustrating too. Sometimes we need appraisals, sometimes we don't. Depends on the dollar amount. Yeah, you go on. I get it.
Okay, nice. Any other questions? No? Cool. Well, if some do come up, obviously reach out. And we'd love to just connect with you guys in person, and that's usually the best way to take the next step is figuring out your exact specific scenario, and then we can put together what would be potential options for you. Sound good? Okay. Thanks for joining. This was a quick one.